These 10 people became wealthy in completely different ways. Some bought cheap companies when nobody else wanted them. Some looked for exceptional businesses and held them for decades. Some built simple strategies that gave ordinary investors access to the market. Some studied currencies, central banks, and global economic cycles. Others used mathematics, data, and computers to find patterns no human eye could see. At first, they seemed completely different. John Templeton bought during moments of maximum pessimism. Philip Fisher looked for outstanding growth companies before the crowd understood them. John Bogle believed most people should stop trying to beat the market and simply own it at low cost. Ray Dalio studied the economic machine and built portfolios designed for different environments. Jim Simons turned investing into a scientific search for hidden patterns in data. George Soros looked for unstable situations where markets, governments, and beliefs were out of balance. Peter Lynch found investment ideas in everyday life. Benjamin Graham searched for undervalued stocks with a margin of safety. Charlie Munger taught that avoiding stupidity may be more important than chasing brilliance. And Warren Buffett combined value, quality, patience, and compounding into one of the greatest investment records in history. But here is what makes this fascinating. They did not all agree with each other. Some were stock pickers. Some were index investors. Some were macro traders. Some focused on businesses. Some focused on systems. Some wanted simplicity. Others built extremely complex models. And yet, each of them understood something about money that most people ignore. Wealth is not usually built by luck alone. It is built by having a clear philosophy, following a disciplined process, controlling emotions, and staying consistent when the world becomes noisy. Most people chase whatever is exciting right now. These investors did something different. They found their own edge. They understood where they had an advantage, and they had the patience to let that advantage work over time. So in this video, we are going to look at the 10 greatest investors of all time, not just to learn how they made money, but to understand the rule, strategy, or mindset that made each one extraordinary. Because if you study them carefully, you will see one powerful truth. There is no single path to wealth, but there are principles that show up again and again. 10. John Templeton. The man who bought when everyone else was terrified. John Templeton was not the loudest investor in history. He was not known for shouting on trading floors, making wild predictions on television, or chasing whatever stock was popular at the moment. In fact, Templeton became one of the greatest investors of all time by doing almost the exact opposite. He looked where others refused to look. He bought when others were afraid, and he built his fortune by understanding one simple but incredibly difficult idea. The best opportunities often appear when things look the worst. John Templeton was born in 1912 in Tennessee. He grew up in a modest family, worked hard, studied at Yale, and later became a Rhodes Scholar at Oxford. But what made Templeton special was not just intelligence, it was temperament. He had the rare ability to stay calm when everyone else was panicking. And in investing, that can be more valuable than almost anything else. Because markets are not only driven by numbers, they are driven by fear, greed, hope, panic, and human emotion. Most investors want to buy when prices are rising and everything feels safe. Templeton wanted to buy when everyone else had already given up. His most famous move came in 1939 at the beginning of World War II. The world was full of uncertainty. Fear was everywhere. Investors were terrified. Many believed the global economy could collapse. But Templeton saw something different. He believed that panic had pushed many stocks far below their true value. So he made a bold decision. He borrowed money and bought shares of more than 100 companies trading at extremely low prices. Some of these companies were in serious trouble. Some were even near bankruptcy. But Templeton was not betting that every single company would survive. He was betting that the market as a whole had become too pessimistic. And he was right. As the economy recovered and markets rebounded, many of those stocks rose dramatically. That one decision became one of the most famous examples of contrarian investing in history. But Templeton's strategy was not simply buy bad companies. That is an important distinction. He was not buying weakness blindly. He was buying extreme pessimism when he believed the price had fallen too far. There is a big difference. A bad company can be cheap and still be a terrible investment, but a decent company bought during panic can become a life-changing opportunity. Templeton understood that price matters. The same stock can be dangerous at one price and attractive at another. The same company can be ignored during fear and overpriced during excitement. This is why he searched globally. At a time when many American investors focused only on the United States, Templeton looked around the world. He wanted to find the cheapest opportunities wherever they existed. If American stocks were expensive, he looked overseas. If Europe was ignored, he studied Europe. If Japan was unpopular, he studied Japan. His mindset was simple. Do not ask where is everyone investing? Ask, where is everyone afraid to invest? That question can change everything, because markets often overreact. When people are excited, they push prices too high. When people are scared, they push prices too low. Templeton built his career by taking advantage of those emotional extremes. His big idea can be summarized in one phrase: maximum pessimism. Templeton believed that the best time to buy was often at the point of maximum pessimism. Not mild concern, not temporary doubt. Maximum pessimism. The moment when the news looks terrible. The moment when people say, "This market is dead." The moment when investors feel embarrassed to own certain assets. The moment when selling feels obvious. That is often when future returns are being created. But here is the problem. Buying at maximum pessimism feels horrible. It does not feel smart. It does not feel safe. It feels like you are making a mistake. Your friends may think you are crazy. The headlines will tell you the situation is getting worse. Experts may warn that things will never recover. And that is exactly why the opportunity exists. If buying were easy, the price would not be low. If everyone agreed it was a great opportunity, it would already be expensive. Templeton's genius was understanding that emotional discomfort is often part of great investing. But this strategy also has risks, and they are serious. The first risk is being too early. A stock can look cheap and then fall another 30, 40, or 50%. A market can seem hated and then become even more hated. Buying during fear does not mean the pain ends tomorrow. Contrarian investing requires patience, sometimes years of patience. The second risk is confusing cheap with valuable. Some investments are cheap for a reason. A company may be dying, an industry may be permanently declining, a country may have deep economic problems, a low price alone is not enough. Templeton did not just buy because something had fallen, he looked for situations where fear had gone too far. That requires research, discipline, and humility. The third risk is emotional pressure. It is easy to talk about buying when others are afraid. It is much harder to actually do it. Imagine putting your money into a market that everyone hates. Imagine watching it fall further after you buy. Imagine waiting while other people make money in more popular investments. Most investors cannot handle that. They give up too soon. Templeton's strategy required something rare: the ability to think independently. He did not need the crowd to agree with him. In fact, if the crowd agreed, the opportunity might already be gone. This is one of the biggest lessons from his life. You cannot outperform the crowd by copying the crowd. If you buy what everyone loves, at the moment everyone loves it, you may be buying at the worst possible price. But if you can calmly study what others are avoiding, you may find value where nobody is looking. That does not mean you should automatically buy every falling stock. It means you should ask better questions. Why is this hated? Is the fear temporary or permanent? Is the business truly broken, or is the market overreacting? What would need to happen for this investment to recover? And most importantly, am I buying because I have done the work, or because I am simply trying to be different? Templeton was not a contrarian for entertainment. He was a contrarian because he believed the crowd often becomes emotional at exactly the wrong time. When people are greedy, they forget risk. When people are fearful, they forget opportunity. Templeton trained himself to see both. For the average investor, the practical lesson is powerful. You do not need to predict every market crash. You do not need to find the next hot stock. You do not need to be smarter than everyone else. But you do need to understand that your emotions can be your enemy. When the market is rising, greed will tell you to chase. When the market is falling, fear will tell you to sell. Templeton's life teaches us to slow down, to think, to question the crowd, to remember that bad headlines do not always mean bad investments, and good headlines do not always mean good prices. The greatest investors are not always the ones with the most complicated strategies. Sometimes they are the ones with the strongest discipline. John Templeton became legendary because he had the courage to buy when others were terrified. But more importantly, he had the patience to wait for the world to realize it had been too pessimistic. That is the real lesson. Wealth is often built not by following excitement, but by recognizing opportunity in fear. And John Templeton proved that sometimes the best investments are found in the places everyone else has abandoned. 9. Philip Fisher, the investor who looked for great companies before everyone else. Philip Fisher was not the type of investor who wanted to buy average companies at cheap prices. He was looking for something different. He wanted exceptional companies, businesses with strong management, long-term growth, innovation, loyal customers, and the ability to become much larger over time. While many investors focused mainly on balance sheets, earnings, and whether a stock looked statistically cheap, Fisher asked a deeper question. What if the best investment is not the cheapest company, but the company with the brightest future? Philip Fisher was born in 1907 in San Francisco. He later studied at Stanford Graduate School of Business, although he left before completing the program. In 1931, during the Great Depression, he founded his own investment firm, Fisher & Company. That timing alone says a lot about him. Starting an investment firm during one of the worst economic periods in modern history required confidence, patience, and independent thinking. But Fisher's legacy did not come from making loud predictions or chasing market trends. It came from developing a new way of thinking about investing. He became one of the pioneers of growth investing, and his ideas influenced many investors who came after him, including Warren Buffett. Buffett is often associated with Benjamin Graham and value investing, but he has also credited Fisher as a major influence. Graham taught investors to look for bargains. Fisher taught them to look for excellence, and that difference matters. Benjamin Graham might ask, is this stock cheap compared to its assets or earnings? Philip Fisher would ask, can this company grow for many years and become far more valuable than it is today? Fisher believed that a truly outstanding company could be worth holding for a very long time. Not weeks, not months, not even just a few years, possibly decades. Because if a company keeps growing, keeps innovating, and keeps increasing its profits, the stock price can follow over time. His most famous investment was Motorola. Fisher bought Motorola shares in the 1950s, when the company was still growing in electronics and communications. He held the stock for decades. That single investment became one of the best examples of his philosophy. He was not trying to jump in and out of the market. He was not trying to trade every headline. He was trying to identify a great business early and stay with it as long as the long-term story remained strong. This is one of the biggest lessons from Fisher's career. The biggest money is often made not by buying and selling constantly, but by finding a truly great company and having the discipline to hold it. But how did Fisher find these companies? This is where his method became famous. He used what he called the scuttlebutt method. The idea was simple, but powerful. Instead of relying only on financial statements, Fisher would talk to people connected to the company: customers, suppliers, competitors, former employees, industry experts, distributors. He wanted to understand the business from the outside in. Were customers satisfied? Was the company respected in its industry? Were competitors worried about it? Did suppliers trust it? Was management honest and capable? Was the company investing in research and development? Did it have room to grow? Fisher believed that numbers were important, but numbers alone were not enough. A financial statement could tell you what had already happened, but conversations with people around the company could help you understand what might happen next. That was his edge. He was searching for quality before it became obvious to everyone else. In a way, Fisher was not just analyzing stocks. He was investigating businesses. His big idea was that a company's future growth could matter more than its current cheapness. A mediocre business bought at a discount might give you a decent return, but an outstanding business bought at a fair price could multiply many times if it kept growing for years. This idea became central to modern investing. It is the reason many investors now talk about buying wonderful companies. A great business can survive recessions. It can raise prices. It can expand into new markets. It can attract talent. It can reinvest profits at high returns. It can become stronger over time. Fisher understood that the best companies are not static. They compound, not just financially, but competitively. Their brand gets stronger. Their customer relationships deepen. Their products improve. Their scale increases. Their data, technology, distribution, and culture become harder to copy. And when a company compounds internally, shareholders can compound with it. But Fisher's strategy also had risks. The first risk is overpaying. A great company is not automatically a great investment at any price. Even the best business can become a poor investment if the stock price already assumes perfection. If investors become too excited, they may push the price so high that future returns become disappointing. This is the danger of growth investing. The story can be true, but the stock can still be too expensive. The second risk is believing the story for too long. Great companies can lose their edge. Technology changes. Competitors improve. Management makes mistakes. Customer behavior shifts. Industries evolve. A company that looked unstoppable can suddenly become vulnerable. Fisher believed in long-term holding, but not blind loyalty. You hold a great company as long as it remains great, not because you fell in love with the stock. The third risk is confusing popularity with quality. A company can be exciting, famous, and widely discussed, but still not be a great business. Hype is not the same as durability. A rising stock price is not the same as a competitive advantage. A charismatic CEO is not the same as strong execution. Fisher's method required deep research, not just enthusiasm. This is why his approach is harder than it looks. Many investors say they want to buy great companies, but they do not do the work to understand what makes a company great. They buy because the stock is popular. They buy because everyone is talking about it. They buy because the chart is going up. That is not Fisher investing. That is just chasing. Fisher wanted evidence. He wanted signs of long-term strength. He wanted to know whether a company had a real advantage and whether management had the ability to keep expanding that advantage. For the average investor, the practical lesson is extremely valuable. Before investing in a company, do not only ask, is the stock cheap? Also ask, is this a business I would want to own for 10 years? Does it have room to grow? Does it treat customers well? Does it invest in the future? Does it have competitors that can easily copy it? Is management honest and capable? Can it keep earning strong profits over time? And maybe the most important question, if the stock market closed tomorrow and I could not sell for 5 years, would I still want to own this company? That question changes your mindset. It forces you to think like an owner, not a gambler. Philip Fisher taught investors that stocks are not just symbols moving on a screen. They represent real businesses, and the best businesses can create enormous wealth over time. His philosophy can be summarized like this: find an outstanding company, understand it deeply, buy it at a reasonable price, then give it time to grow. That sounds simple, but it is not easy. Because holding a great company requires patience, it requires ignoring short-term noise, it requires accepting volatility, it requires resisting the temptation to constantly trade. And most of all, it requires the discipline to focus on business quality, not just stock price movement. Philip Fisher's legacy is that he helped investors see the power of growth, quality, and long-term ownership. He showed that the greatest investments are not always the cheapest stocks. Sometimes, the greatest investments are exceptional companies that still have decades of growth ahead. And if you can find them early, understand them better than the crowd, and hold them through uncertainty, one great company can change your financial life. 8. John Bogle. The man who made investing simple, John Bogle, did not become one of the most important investors in history by picking the hottest stocks. He did not build his legacy by predicting crashes, trading currencies, or discovering unknown companies before everyone else. In fact, Bogle became legendary by telling ordinary investors something Wall Street did not want them to hear. Most people do not need to beat the market. They need to own the market. That one idea changed investing forever. John Clifton Bogle was born in 1929 in New Jersey, just before the Great Depression. His family went through financial hardship when he was young, and that experience shaped how he thought about money. He understood that investing was not just a game for rich people. It was a tool that could help normal families build security, independence, and dignity over time. Bogle studied economics at Princeton University, where he wrote a thesis about mutual funds. That thesis would later become the foundation for his life's work. In 1974, he founded Vanguard, and in 1976, Vanguard launched the first index mutual fund available to individual investors. At the time, many people mocked the idea. They called it boring. They said it was un-American to simply accept the market return instead of trying to beat it. Some even called the fund Bogle's Folly. But Bogle understood something powerful. The average investor does not fail because the market is bad. The average investor often fails because costs, emotions, and bad timing quietly destroy their returns. His investing philosophy was simple. Instead of trying to guess which stock will win, buy a broad slice of the entire market. Instead of paying expensive managers to try to outperform, use a low-cost index fund. Instead of constantly trading, hold for decades. Instead of chasing excitement, let compounding work. That was Bogle's revolution. He took an industry built on complexity and made it simple. Wall Street often makes investing sound complicated. There are forecasts, strategies, charts, ratings, hot funds, star managers, economic predictions. But Bogle believed that most of this activity did not help the ordinary investor. In fact, it often hurt them. Because every fee matters. Every commission matters. Every unnecessary trade matters. Every percentage point lost to costs is a percentage point that cannot compound for your future. Bogle's big idea was that costs are one of the few things investors can actually control. You cannot control what the market does tomorrow. You cannot control interest rates. You cannot control recessions. You cannot control the next crisis. You cannot control whether a fund manager will outperform. But you can control how much you pay, and over decades, that difference can be enormous. Imagine two investors. Both earn the same market return before fees. One pays high fees every year. The other pays very low fees. At first, the difference seems small, almost invisible. But after 20, 30, or 40 years, the gap can become life-changing. That is the hidden power of low-cost investing. It does not look exciting in the beginning, but time magnifies small differences. Bogle wanted investors to keep more of what they earned. That sounds obvious, but it was radical in an industry that made money by charging investors more. He often said that in investing, you get what you do not pay for. The less you pay in fees, the more of the market return you keep. This is why index investing became so powerful. An index fund does not need to hire expensive managers to guess which companies will outperform. It simply tracks a market index. If the market grows over time, the investor participates. Not perfectly every year, not without volatility, but broadly, patiently, and at low cost. Bogle believed that this approach was not just efficient, it was fair. It gave ordinary people access to the same market returns that professionals were chasing, and it removed the need to make impossible predictions. You did not need to know which company would dominate the next decade. You did not need to know when the next crash would happen. You did not need to choose the winning fund manager. You just needed discipline, diversification, low costs, and time. That combination may sound simple, but it is extremely powerful. His big idea can be summarized in one phrase: don't look for the needle in the haystack. Buy the haystack. Instead of trying to find the one perfect stock, own thousands of companies through a broad index fund. Some will fail. Some will disappoint. Some will stay average, but a few will become huge winners. And by owning the whole market, you make sure you own those winners too. This is one of the greatest advantages of index investing. You do not have to predict the future correctly. You only have to participate in it. If innovation continues, if businesses keep creating value, if economies grow over long periods, then the broad market can reward patient owners. But Bogle's strategy also has risks. The first risk is that simple does not mean easy. Buying an index fund is simple. Holding it during a market crash is not. When the market falls to 20, 30, or 50%, fear becomes very real. The news becomes terrifying. People start saying the system is broken. Investors panic. And suddenly, the simple strategy feels impossible. Bogle understood that the greatest enemy of the index investor is not the market. It is behavior. If you sell during panic and buy back later at higher prices, even the best index fund cannot save you. The second risk is impatience. Index investing does not usually make you rich overnight. It is not designed for quick excitement. It is designed for long-term compounding. That means there will be years when it feels slow. There will be years when other strategies look smarter. There will be people making money faster. There will be trends that seem more exciting. The challenge is staying with a plan that works slowly while the world is constantly advertising shortcuts. The third risk is misunderstanding diversification. Owning the market does not mean you cannot lose money. It means you are not dependent on one company, one CEO, or one industry. A broad index fund can still fall sharply, but it is less likely to go to zero than a single stock. Diversification protects you from being completely wrong about one company. It does not protect you from every downturn. This is important. Bogle never promised that index investing would eliminate pain. He promised that it would give investors a fair, low-cost, disciplined way to capture market returns over time. That is very different. Another risk is valuation. If the entire market becomes expensive, future returns may be lower. Index funds do not avoid overvalued stocks. They own the market as it is. This means index investors must accept that returns will vary depending on when they invest and how long they hold. But Bogle's answer was not to jump in and out of the market. His answer was to keep costs low, diversify broadly, and stay the course. That phrase, stay the course, became one of his most famous messages. It sounds simple, but in investing, simple truths are often the hardest to follow. Stay the course when stocks fall. Stay the course when headlines scare you. Stay the course when your neighbor brags about a hot investment. Stay the course when you feel bored. Stay the course when you feel tempted to do something dramatic. Because in many cases, the best action is no action. This is one of Bogle's most powerful lessons. Investing success is not always about doing more. Sometimes it is about doing less. Less trading, less guessing, less reacting, less paying, less chasing, more patience, more ownership, more discipline, more time. For the average investor, the practical lesson is clear. You do not need to become a stock-picking genius to build wealth. You do not need to watch financial news every day. You do not need to predict recessions. You do not need to find the next Warren Buffett. You need a plan you can actually follow. For many people, that plan may be a diversified, low-cost index fund held for decades. Invest regularly. Avoid high fees. Do not panic during downturns. Do not chase performance. Reinvest. Let compounding do its work. And keep your strategy simple enough that you can stick with it. Because a simple plan followed for 30 years is often better than a brilliant plan abandoned after 3 months. John Bogle's legacy is not just that he created an investment product. His legacy is that he changed who investing was for. Before Bogle, much of Wall Street was built around experts telling ordinary people they needed help, complexity, and expensive management. Bogle said ordinary investors deserved better. They deserved transparency. They deserved low costs. They deserved access. They deserved to keep more of their own money. And that idea changed millions of lives. He proved that boring can be brilliant, that average market returns can be extraordinary if you capture them consistently, that low fees are not a small detail, but a major advantage, and that the most powerful investment strategy is often the one you can understand, trust, and hold through every market cycle. John Bogle did not teach investors how to beat the market. He taught them how to stop beating themselves. And for most people, that may be the most important investing lesson of all. 7. Ray Dalio. The investor who studied how the economic machine works, Ray Dalio, did not become one of the most successful investors in history by focusing only on individual stocks. He was not just asking, which company is cheap, which business is growing, which stock will go up next. Dalio was asking a much bigger question: how does the entire economic machine work? That question became the foundation of his career. While many investors focused on companies, Dalio focused on systems: debt cycles, interest rates, currencies, inflation, central banks, political risk, global capital flows, human behavior. He wanted to understand how all these forces connected, because in his view, the economy was not random. It moved in patterns, and if you could understand those patterns better than others, you could make better decisions. Ray Dalio was born in 1949 in Queens, New York. He started investing when he was very young, buying his first stock as a child. That early experience sparked a lifelong obsession with markets. Later, he studied finance, worked on Wall Street, and in 1975, he founded Bridgewater Associates from his apartment. Bridgewater would eventually become one of the largest and most influential hedge funds in the world. But Dalio's rise was not smooth. One of the most important moments of his career came in the early 1980s. Dalio became convinced that the U.S. economy was heading into a serious debt crisis. He believed the system was under pressure and that a depression-like event could happen. He was public about his view. He was confident, and he was wrong. Instead of collapsing, the economy recovered. Stocks entered a powerful bull market, and Dalio's mistake nearly destroyed his business. He had to lay off employees. He lost money. He was forced to borrow from his father to keep going. For many people, that kind of failure would have ended the story. But for Dalio, it became the turning point. He realized that confidence was dangerous when it was not balanced by humility. He learned that even smart people can be completely wrong. And he decided to build an investment process that did not depend on one person's opinion. This became one of the most important ideas in his career. Do not trust your own certainty too much. Markets are complex, the future is uncertain, and the biggest risks are often the ones you are most convinced cannot happen. After that failure, Dalio became obsessed with systems, diversification, and decision-making. He wanted to create portfolios that could survive different economic environments, not just the environment he expected, but the environments he might be wrong about. This led to one of his most famous concepts, the all-weather portfolio. The idea was simple but powerful. Most investors build portfolios that do well only when their preferred scenario happens. For example, many people own mostly stocks. That can work beautifully when growth is strong and markets are rising. But what happens when inflation spikes? What happens when interest rates rise? What happens when deflation hits? What happens when growth collapses? Dalio wanted a portfolio designed for different seasons. Just like the weather changes, economic conditions change. Sometimes there is growth. Sometimes there is recession. Sometimes inflation rises. Sometimes inflation falls. Sometimes cash is safe. Sometimes cash loses purchasing power. The goal was not to predict the weather perfectly. The goal was to build something that could survive many kinds of weather. That is why Dalio focused on balancing risk, not just balancing dollars. This is a key point. A normal investor might think a portfolio is diversified because it owns many different assets. But if all those assets depend on the same economic condition, the portfolio may not be truly diversified. For example, stocks from different companies may look diversified, but in a major market crash, many of them can fall together. Dalio believed true diversification meant owning assets that behave differently in different environments. Stocks, bonds, commodities, inflation-linked assets, cash, assets that benefit from growth, assets that protect against inflation. assets that may perform better when growth disappoints. His big idea was that investors should not bet everything on one version of the future, because the future has a way of surprising everyone. This is why risk parity became closely associated with Dalio and Bridgewater. Instead of letting stocks dominate portfolio risk, risk parity tries to spread risk more evenly across asset classes. The goal is not simply to own many things. The goal is to avoid being destroyed by one wrong assumption. Dalio's investing philosophy is also deeply connected to history. He believes that to understand markets, you must study past cycles, debt crises, currency devaluations, inflationary periods, wars, political transitions, rising powers, declining powers, central bank responses. In his view, many events feel unprecedented to people living through them, but often they have happened in some form before. The details change. The technology changes. The countries change. But human behavior repeats. People borrow too much. Assets become overpriced. Confidence rises. Then conditions shift. Debt becomes painful. Fear spreads. Governments respond. Central banks print money or tighten money. Cycles begin again. Dalio studied these patterns because he believed history gives investors a map. Not a perfect map, but a useful one. If you only study the last few years, you may think the current environment is normal. But if you study centuries of markets, you realize that normal changes all the time. Periods of low inflation do not last forever. Periods of high growth do not last forever. Reserve currencies can lose power. Debt cycles can reshape societies. Political conflict can affect markets. And investors who ignore these forces may be caught completely unprepared. But Dalio's strategy also has risks. The first risk is complexity. Macroeconomic investing is difficult, very difficult. It requires understanding many moving parts at once. Interest rates, currencies, inflation, global trade, government policy, debt, and investor psychology can all interact in unpredictable ways. Even if your logic is good, your timing can be wrong. Even if your thesis is right, the market can move against you for years. This is why most ordinary investors should be careful about trying to copy complex macro strategies. Dalio had teams, data, models, research systems, and decades of experience. The average investor does not. The second risk is overconfidence in models. Models can help organize thinking, but models are not reality. They are simplifications. They depend on assumptions. And when the world changes in unexpected ways, models can fail. Dalio understood this better after his early failure, but it remains a major risk for anyone who tries to turn the economy into a machine that can be perfectly predicted. The economy is influenced by humans, and humans are not machines. They panic, they overreact, they change rules, they make political decisions, they surprise each other. The third risk is that diversification can disappoint. A diversified portfolio may protect you from disaster, but it can also feel frustrating. When one asset class is booming, a diversified portfolio may lag behind it. If stocks are rising rapidly, holding bonds, commodities, or cash may feel unnecessary. People may look at a more balanced portfolio and think, why not just own the thing that is going up the most? But the answer only becomes clear during the next crisis. Diversification often feels useless right before it becomes essential. That is the emotional challenge. The fourth risk is that all weather does not mean no losses. This is extremely important. No portfolio is magic. A portfolio designed to handle many environments can still lose money. It can still suffer during unusual market conditions. It can still underperform. The goal is resilience, not perfection. Dalio's approach is not about avoiding all pain. It is about avoiding total dependence on one prediction. For the average investor, the practical lesson from Ray Dalio is not that you need to become a hedge fund manager. It is not that you need to trade currencies, forecast central banks, or build complicated models. The real lesson is simpler and more useful. Prepare for being wrong. Most investors build their portfolios around what they believe will happen. Dalio teaches us to ask a better question. What if I am wrong? What if inflation stays high? What if rates do not fall? What if stocks underperform? What if my country's currency weakens? What if the next decade looks nothing like the last decade? That question can make you a better investor, not because it makes you fearful, but because it makes you realistic. A strong portfolio should not depend on perfect predictions. It should be able to survive uncertainty. Another practical lesson is to study cycles. Do not assume that today's conditions will last forever. When money is cheap, people act one way. When money becomes expensive, they act differently. When debt is easy, asset prices can rise. When debt becomes painful, markets can change quickly. Understanding these cycles can help you avoid extreme behavior. You become less likely to chase bubbles, less likely to panic in downturns, less likely to believe that the current environment is permanent. Dalio also teaches the value of radical open-mindedness. This idea goes beyond investing. He believes that good decisions come from seeking out thoughtful disagreement, not surrounding yourself with people who agree with you, not defending your ego, not pretending you are always right, but actively asking, what am I missing? Who sees this differently? What evidence would prove me wrong? That mindset is incredibly valuable in markets, because markets punish arrogance. They do not care how confident you are. They do not care how smart you sound. They only care about reality. And reality is often more complicated than our opinions. Ray Dalio's legacy is that he helped investors think in systems. He showed that markets are connected to the broader economy, that debt cycles matter, that diversification must be deeper than owning many stocks, that risk should be balanced, that history matters, and that humility is not weakness, it is a survival tool. His story is powerful because his greatest lesson came from being wrong. He made a major mistake, nearly lost everything, and used that failure to build a better way of thinking. That may be the most important lesson of all. The best investors are not the ones who are never wrong. They are the ones who learn before one mistake destroys them. Ray Dalio built his career by studying how the economic machine works. But what he really teaches is this: you cannot control the future. You cannot predict every crisis. You cannot know exactly which environment is coming next. But you can build a strategy that respects uncertainty. And in investing, respecting uncertainty may be one of the greatest advantages you can have. 6. Jim Simons. The mathematician who turned markets into data, Jim Simons was not a traditional investor. He did not become legendary by reading annual reports like Warren Buffett. He did not search for great growth companies like Philip Fisher. He did not build his reputation by explaining economic cycles like Ray Dalio. Jim Simons came from a completely different world. He was a mathematician, a code breaker, a professor, a pattern hunter. And when he entered finance, he brought a radical idea with him. Maybe markets are not perfectly predictable, but maybe they contain tiny patterns that can be discovered with mathematics, data, and computers. That idea helped create one of the most successful investment firms in history. Jim Simons was born in 1938 in Massachusetts. Before he became famous on Wall Street, he had already built an extraordinary career in mathematics. He studied at MIT and earned a PhD from the University of California, Berkeley. He worked as a code breaker during the Cold War and later became a respected academic mathematician. This background shaped everything about the way he invested. Most investors looked at companies. Simons looked at numbers. Most investors asked, is this business undervalued? Is the management strong? Will earnings grow? Simons asked something else. Is there a repeatable pattern in the data? That question became the foundation of Renaissance Technologies, the firm he founded in 1978. Renaissance became famous for using mathematical and statistical methods to design and execute investment strategies. And its most famous fund, the Medallion Fund, became almost mythical. The reported performance of Medallion is difficult to compare with almost anything else in investing history. Reuters reported that the fund achieved average annual returns of over 60% for 3 decades under Simons' leadership, while other accounts have reported nearly 40% annually after fees over a longer period. But the most important part of Simons' story is not just the return. It is how different his approach was. Simons did not try to predict the future in the normal Wall Street way. He did not sit in front of a camera and say where the economy was going. He did not rely on instinct, charisma, or market gossip. He built systems. He hired mathematicians, physicists, statisticians, computer scientists, and signal processing experts. Many of them were not Wall Street people at all. And that was the point. Simons believed that traditional finance thinking could be a disadvantage. If everyone in the market is using the same language, reading the same reports, and asking the same questions, it becomes harder to find something truly different. So, Renaissance looked for people who could think from first principles, people who could model uncertainty, people who could detect weak signals inside massive amounts of noise, people who understood that a small edge, repeated thousands or millions of times, could become extremely powerful. This is the heart of quantitative investing. A normal investor might try to find one great company and hold it for years. A quant investor might try to identify thousands of tiny statistical advantages across many trades. Each individual trade may not matter much, but together, if the system has an edge, the results can compound. This is what made Simons so different. He was not looking for one big obvious opportunity. He was looking for small invisible patterns. Patterns in price movements, patterns in volume, patterns in relationships between assets, patterns in how markets reacted to information, patterns that humans might never notice, but computers could test. His big idea was that markets leave clues. Not simple clues, not guaranteed clues, but statistical clues. And if you collect enough data, test enough hypotheses, remove enough emotion, and execute with enough discipline, you may find signals that other investors miss. This was revolutionary because it challenged the romantic image of the great investor. The traditional image is someone sitting alone, reading, thinking deeply, and making a brilliant decision. Simons replaced that image with teams, models, code, data pipelines, and constant testing. He turned investing from an art into something closer to applied science. But he also understood that models were not magic. A bad model can lose money very quickly. A model that worked yesterday may stop working tomorrow. A pattern can disappear once too many people discover it. Markets change. Data can mislead. Noise can look like signal. That is why Renaissance became known for secrecy, research, and constant refinement. The edge was not just one formula, it was the whole machine. The data, the people, the testing, the risk controls, the execution, the culture, the willingness to throw away ideas that did not work. And maybe most importantly, the humility to let evidence beat opinion. In many investment firms, the most confident person in the room can dominate the conversation. At Renaissance, the data had to matter more than the ego. If a theory sounded smart but did not test well, it was not useful. If a pattern looked strange but kept working across data, it deserved attention. This is one of the most powerful lessons from Simons. You do not need to have a beautiful story. You need to know what works. That sounds simple, but it is deeply uncomfortable. Humans love stories. We want to explain everything. We want to believe that every market move has a clear reason. Stocks fell because of this headline. Currencies moved because of that speech. Commodities rose because of this report. But Simons approached markets differently. He did not need every pattern to have a perfect human explanation. If the data showed a repeatable edge, that was enough to investigate. This is what made his style so powerful and so alien to traditional investors. He trusted statistical evidence more than narrative, but this strategy also has serious risks. The first risk is overfitting. Overfitting happens when a model looks brilliant on past data, but fails in the real world. Imagine studying years of market history and finding a pattern that seems profitable, but maybe the pattern is not real. Maybe it is just randomness. Maybe it worked only because of a unique period. Maybe it disappears the moment you trade it. This is one of the greatest dangers in quantitative investing. The past contains endless patterns. Not all of them mean anything. A good quant investor must separate real signal from accidental noise. The second risk is competition. once a profitable pattern is discovered, others may eventually find it too. And when too much money chases the same edge, the edge can shrink or disappear. This means quant investing is a constant race. You cannot simply discover one strategy and relax forever. You must keep improving, keep researching, keep adapting, keep questioning. The third risk is technology and execution. In quantitative trading, being right is not enough. You also need to trade efficiently. Costs matter. Speed can matter. Data quality matters. Infrastructure matters. A small edge can disappear if trading costs are too high or execution is poor. This is very different from long-term investing, where one decision might play out over years. In Simon's world, many decisions could happen quickly, and tiny details could make the difference between profit and loss. The fourth risk is that ordinary investors cannot easily copy this strategy. This may be the most important warning. Jim Simon's success was not just use math to trade. It was the result of extraordinary talent, huge data resources, advanced technology, disciplined research, and a unique organization built over decades. A normal person with a laptop should not assume they can replicate Renaissance technologies. Many people try to copy quant trading and end up curve-fitting strategies, overtrading, or trusting models they do not fully understand. The lesson from Simon's is not that everyone should become a high-frequency quant trader. The lesson is deeper. Use evidence, remove emotion, test your assumptions, respect data, and do not confuse a good story with a good strategy. For the average investor, Jim Simon's teaches a very practical idea. Your opinions are not enough. You may believe a stock is going up. You may feel that a market is cheap. You may think a trend will continue, but why? What evidence supports it? What would prove you wrong? Are you making a decision based on data or based on excitement? Are you investing or just telling yourself a convincing story? Simon's career is a reminder that markets are brutally competitive. If you want an edge, you need a reason why your decision is better than the crowd's decision. That edge could be patience, it could be low costs, it could be deep research, it could be emotional discipline, it could be a long time horizon, or, in Simon's case, it could be mathematics and data, but there must be an edge. Without one, you are not investing with an advantage. You are gambling against professionals. Another lesson is the power of teams. Simon's was brilliant, but Renaissance was not built on one person alone. It was built on a culture of exceptional people working together. Mathematicians, scientists, programmers, researchers, people who challenged each other's ideas, people who cared more about results than status. This matters because many investors imagine success as a solo activity. One genius, one big insight, one perfect trade. But Simon's showed that some of the greatest results can come from building the right system and the right team. The system matters. The process matters. The feedback loop matters. Over time, a strong process can become more powerful than any single prediction. That may be Jim Simon's greatest lesson. He did not try to win by being louder. He did not try to win by making dramatic forecasts. He tried to win by creating a machine that learned from data, tested ideas, controlled risk, and improved over time. And that machine changed finance. Jim Simon's proved that investing could be approached in a completely different way. Not through intuition, not through Wall Street tradition, not through emotional conviction, but through mathematics, statistics, computation, and relentless testing. His legacy is not just that he made billions. His legacy is that he changed what investors believed was possible. He showed that hidden patterns could exist in markets. He showed that scientific thinking could beat traditional assumptions. And he showed that sometimes the greatest investor in the room is not the person with the strongest opinion. It is the person most willing to let the evidence speak. Jim Simon's turned markets into data. And by doing that, he became one of the most successful investors the world has ever seen. 5. George Soros. The investor who understood that markets can be wrong. George Soros did not become one of the most famous investors in history by looking for safe, obvious opportunities. He became famous by doing something much more difficult. He looked for moments when the entire market was wrong. Not slightly wrong, not temporarily confused, but deeply wrong. He searched for situations where prices, expectations, politics, economics, and human psychology were moving together in a way that could not last forever. And when he found one, he was willing to make a massive bet. That is what made George Soros different. He was not just a stock picker. He was not just a trader. He was a macro investor. He studied currencies, interest rates, governments, central banks, economic policy, debt, and investor psychology. He wanted to understand how big forces shaped markets, and more importantly, he wanted to understand when those forces became unstable. George Soros was born in Budapest, Hungary in 1930. As a teenager, he survived the Nazi occupation of Hungary, an experience that shaped his view of uncertainty, survival, and history. After the war, he moved to London, studied at the London School of Economics, and was influenced by philosopher Karl Popper's ideas about open societies and imperfect knowledge. That last point is important. Soros did not believe people understood reality perfectly. He believed people act based on imperfect perceptions, and when enough people act on those perceptions, they can actually change reality. This became the foundation of his most famous idea, reflexivity. Reflexivity is the idea that markets are not just passive mirrors of reality. Markets can influence the reality they are supposed to reflect. For example, if investors believe a company is strong, its stock price may rise. A higher stock price can help the company raise capital, hire talent, make acquisitions, and appear even stronger. So the belief helps create the reality, but the opposite can also happen. If investors believe a company is weak, the stock may fall. A falling stock price can damage confidence, make financing harder, hurt employee morale, and create real weakness. Again, perception changes reality. This is very different from the idea that markets are always rational and efficient. Soros believed markets can create feedback loops. Optimism can feed more optimism. Fear can feed more fear. A trend can become stronger simply because people believe in it. But eventually, if the trend moves too far away from reality, it can break. That breaking point is where Soros looked for opportunity. His big idea was not simply to predict the future. It was to identify unstable situations. Situations where the market believed one thing, but the structure underneath could not support that belief forever. The most famous example came in 1992. At the time, the British pound was part of the European exchange rate mechanism, which tried to keep currencies within certain limits. Soros believed the pound was overvalued and that Britain would not be able to defend it without causing serious economic damage. His fund built a huge short position against the pound. On Black Wednesday, Britain withdrew from the mechanism, the pound fell, and Soros's fund reportedly made around $1 billion in profit. That trade made him known as the man who broke the Bank of England. But that nickname can be misleading. Soros did not break the pound by himself. He saw a weakness that already existed. The British government was trying to maintain a currency level that the market and economy could no longer support. Soros recognized the pressure point. Then he bet aggressively. This is what separates his style from many other investors. Warren Buffett often looks for wonderful businesses at reasonable prices. John Bogle taught investors to own the whole market at low cost. Philip Fisher searched for companies with long-term growth. Jim Simons found statistical patterns in data. George Soros looked for cracks in the system. He wanted to know where policy, psychology, and market prices were out of balance. And when he believed the imbalance was real, he was willing to act with enormous conviction. But Soros's strategy was not just about being aggressive, it was also about being flexible. This is one of the most important parts of his philosophy. Soros understood that he could be wrong. He did not believe intelligence made him immune to mistakes. In fact, his entire theory of reflexivity is built on the idea that human understanding is imperfect. That includes his own understanding. So while he could make bold bets, he also believed in changing his mind when the facts changed. This is a crucial lesson. Many investors confuse conviction with stubbornness. They buy something, defend it emotionally, and refuse to admit when the thesis is broken. Soros was different. He wanted to find big opportunities, But he also knew that survival required humility. If the market proved him wrong, he had to adjust. This combination is rare. Aggressive when the opportunity is strong. Flexible when the evidence changes. Most people are the opposite. They are timid when opportunity appears and stubborn when they are wrong. Soros's big idea can be summarized like this. Markets are driven by human perception, and human perception can push prices far away from reality. That creates danger, but it also creates opportunity. When investors become too confident, they may ignore risk. When governments defend unsustainable policies, they may create pressure that eventually explodes. When a bubble forms, rising prices may temporarily make the bubble look justified. And when fear takes over, falling prices may create more fear. Soros studied these feedback loops. He wanted to understand not only what was happening, but how beliefs were changing behavior. This made him one of the most important figures in global macro investing. But his strategy also had serious risks. The first risk is that macro investing is extremely difficult. It is hard enough to analyze one company. Soros was analyzing entire countries, currencies, interest rates, political decisions, central banks, and investor behavior. There are countless variables, and any one of them can change suddenly. A central bank can surprise the market. A government can change policy. A crisis can create unexpected reactions. A trade that looks logical can lose money for months or years before it works. Or it may never work at all. The second risk is timing. You can be right about an imbalance and still lose money if you are too early. A currency can remain overvalued longer than expected. A bubble can keep rising. A flawed policy can survive longer than logic suggests. Markets can stay irrational long enough to punish people who are technically right, but financially early. This is why Soros's approach required not just insight, but risk control. The third risk is leverage. Large macro trades often use borrowed money or derivatives to magnify returns. That can create enormous profits, but it can also create enormous losses. When you are wrong with leverage, you do not just lose slowly, you can lose quickly. This is one reason ordinary investors should be very careful about trying to copy Soros directly. His famous trades were not casual bets. They required deep research, experience, capital, risk management, and the ability to survive being wrong. The fourth risk is psychological pressure. Imagine betting against a major currency. Imagine betting against a central bank. Imagine taking a position so large that the entire financial world notices. That requires a level of emotional control most investors do not have. When the market moves against you, doubt becomes intense. When headlines attack your position, fear grows. When other investors disagree, confidence weakens. Soros had the ability to think independently under pressure. That was part of his edge. But even for him, this kind of investing was not easy. For the average investor, the practical lesson from George Soros is not go short a currency. It is not make huge leveraged macro bets. And it is definitely not try to fight central banks from your laptop. The real lesson is much more useful. Learn to recognize when perception and reality are moving apart. Sometimes a stock goes up, not because the business is improving, but because people believe it will keep going up. Sometimes an asset becomes expensive because a story becomes popular. Sometimes everyone repeats the same narrative until it feels like truth. But a popular story is not the same as a durable reality. Soros teaches us to ask, what does the market believe right now? What has to be true for that belief to continue? What could break the feedback loop? Is the trend supported by fundamentals or only by confidence? And if confidence disappears, what happens next? Those questions are powerful. They help investors avoid bubbles. They help investors avoid blindly following the crowd. They help investors understand that prices are not always facts. Prices are often opinions expressed with money. Another lesson is the value of flexibility. You can have a strong view, but you must be willing to change it. The market does not reward ego. It rewards accurate thinking, disciplined action, and survival. If new evidence proves your thesis wrong, the intelligent move is not to defend your pride. The intelligent move is to adapt. This is one of Soros's most important qualities. He could be bold without pretending to be infallible. That is rare. Many investors are either confident or humble. Soros tried to be both, confident enough to act, humble enough to know he might be wrong. There is also a deeper lesson about markets themselves. Markets are not just numbers. They are human systems. They are shaped by belief, fear, greed, policy, memory, trauma, optimism, and panic. A spreadsheet can tell you a lot, but it cannot tell you everything. To understand markets, you also need to understand people. Why are they buying? Why are they selling? What story do they believe? What are they afraid of? What are they ignoring? Soros built his career by studying these questions at the highest level. His legacy is complicated because he is also a major political donor and philanthropist, and public debate around him often becomes intense. But from an investing perspective, his importance is clear. He helped show that markets can be unstable, emotional, and reflexive, and that the greatest opportunities sometimes appear when a widely accepted belief begins to crack. George Soros became legendary because he understood something most investors forget. Markets can be wrong, governments can be wrong, crowds can be wrong, experts can be wrong, and even you can be wrong. The goal is not to pretend you know everything. The goal is to see clearly when others are trapped inside a belief, to act when the odds are in your favor, to manage risk when you might be mistaken, and to change your mind before a mistake becomes fatal. That is the real lesson from George Soros. He did not just bet on markets. He studied the beliefs behind markets, and by understanding how those beliefs could shape reality, then collapse under their own pressure, he became one of the most successful macro investors in history. 4. Peter Lynch. The investor who found great stocks in everyday life, Peter Lynch did not become one of the greatest investors in history by sitting in an ivory tower. He did not rely only on complex formulas. He did not need a PhD in economics. And he did not believe that ordinary people were powerless against Wall Street professionals. In fact, Lynch believed something very different. He believed that regular people could sometimes spot great investment opportunities before professional investors noticed them. Not because they had better spreadsheets, not because they had secret information, but because they lived in the real world. They shopped in stores. They used products. They saw which restaurants were crowded. They noticed which brands their kids loved. They could see trends forming in everyday life before those trends appeared in financial reports. That idea became one of Peter Lynch's most famous lessons: invest in what you know. But that phrase is often misunderstood. Lynch did not mean you should buy a stock just because you like a product. He did not mean that if a restaurant is busy, you should immediately buy the company. He meant that everyday observation can be the beginning of research, not the end of research. Peter Lynch was born in 1944 in Massachusetts. He studied at Boston College and later earned an MBA from the Wharton School. After serving in the U.S. Army, he joined Fidelity Investments. In 1977, Lynch became manager of the Fidelity Magellan Fund. At the time, the fund was relatively small, but under his management, it became one of the most famous mutual funds in the world. From 1977 to 1990, Lynch delivered an extraordinary track record, averaging about 29% annual returns and growing Magellan's assets from millions into billions. But what made Lynch so fascinating was not just the performance, it was the way he explained investing. He made investing feel understandable. He had a gift for turning complex ideas into simple, memorable lessons. He talked about companies in plain language. He categorized stocks. He looked for businesses with room to grow. And he believed that investors should actually understand what they own. This sounds obvious, but many people do the opposite. They buy stocks because someone mentioned them online. They buy because the price is going up. They buy because a headline sounds exciting. They buy because they are afraid of missing out. Then, when the stock falls, they have no idea what to do. They do not know whether to buy more, hold, or sell, because they never understood the business in the first place. Lynch wanted investors to think differently. Before buying a stock, he believed you should be able to explain the story simply. What does the company do? Why do customers like it? How does it make money? How can it grow? What could go wrong? Is the stock price reasonable compared to the opportunity? If you cannot explain why you own a company, you probably should not own it. One of Lynch's most famous concepts was the 10-bagger. A 10-bagger is a stock that rises 10 times in value. A $1,000 investment becomes $10,000. A $10,000 investment becomes $100,000. These are the kinds of investments that can transform a portfolio. But Lynch understood something important. You do not need every stock to be a 10-bagger. You only need a few big winners as long as you do not sell them too early. This is one reason he loved companies with long growth runways. A small company expanding across the country. A retailer opening more stores. A restaurant chain moving into new markets. A consumer brand gaining loyal customers. A business with a simple model that could be repeated many times. These companies might not look impressive at first, but if they keep growing year after year, the stock can multiply. Lynch was especially interested in companies that Wall Street had not fully discovered yet. He liked situations where the story was simple, the business was improving, and the market had not priced in the full opportunity. He did not need a company to be glamorous. In fact, he often liked boring businesses. If a company had an unexciting name, operated in a dull industry, and was ignored by analysts, that could be a good thing. Why? Because boring companies can be mispriced. When nobody is paying attention, expectations may be low. And when expectations are low, good results can surprise the market. This is classic Peter Lynch thinking. Look where others are not excited. Study what is actually happening. Find companies with growth, profitability, and a reasonable price. Then be patient. But Lynch was not just a growth investor. He was flexible. He looked at different types of companies in different ways. He described categories like slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. This was important because not every stock should be judged the same way. A fast-growing company should be evaluated differently from a cyclical company. A turnaround should be evaluated differently from a stable blue-chip business. A cheap stock is not always cheap for the same reason. A high-growth company is not always attractive at any price. Lynch wanted investors to understand the category of the company they were buying. Because if you misunderstand the type of stock, you may misunderstand the entire investment. For example, a cyclical company may look cheap at the top of the cycle because earnings are temporarily high. Then profits fall, and the stock collapses. A turnaround may look risky, but if the company survives and improves, the upside can be large. A fast grower may look expensive, but if it keeps expanding for years, the price may be justified. The key is knowing what game you're playing. Lynch's big idea was that individual investors can have an edge if they combine real-world observation with serious research. The observation gives you the clue. The research confirms whether the clue matters. Maybe you notice a store that is always crowded. That is not enough. Now you need to ask, is the company publicly traded? Are sales actually growing? Are profits growing too? Can the business expand? Does it have too much debt? Is management capable? Is the stock already too expensive? Are competitors copying it? This is where many investors fail. They stop at the story. Lynch wanted investors to go further. A good story must be backed by numbers. A product you love does not automatically make a great investment. A popular brand can still be overvalued. A fast-growing company can still lose money. A great business can still be a bad stock if the price is too high. This is why Lynch's approach was both simple and disciplined. Simple enough for ordinary people to understand. Disciplined enough to avoid pure speculation. But his strategy also had risks. The first risk is overconfidence. Because Lynch encouraged people to look at everyday life, some investors think they can buy stocks based only on personal experience. They see a crowded restaurant and assume the stock will rise. They like a product and assume the company is great. They use an app and assume it will dominate the world. But personal experience is only one data point. It can be biased, it can be local, it can be temporary. It may not reflect the company's national or global performance. Lynch never said, buy what you know and stop there. He said, in effect, use what you know as a starting point, then do the work. The second risk is selling winners too early. This is one of the hardest parts of investing. Imagine buying a stock and watching it double. Most people want to take the profit quickly. They feel smart, they feel safe. They do not want to lose the gain. But if the company has the potential to grow for many more years, selling after a double may be a huge mistake. Many 10-baggers require patience. They do not go straight up. They fall. They stall. They get criticized. They test your conviction. If you sell every winner too early, your portfolio may never benefit from the rare stocks that create extraordinary returns. The third risk is holding losers too long. This is the opposite problem. Investors often sell winners quickly and keep losers forever. Why? Because selling a loser means admitting a mistake. So they wait. They hope. They tell themselves the stock will come back. Sometimes it does, but sometimes the business is broken. Lynch believed investors needed to monitor the story. If the original reason for buying is no longer true, you must reconsider. Hope is not an investment strategy. The fourth risk is ignoring valuation. Even Lynch, who loved growth, cared about price. A company can have a great future, but if the stock already prices in perfection, returns may disappoint. Investors often get excited by the story and forget the math. How much growth is already expected? How much must go right? What happens if the company grows, but not as fast as investors hoped? A great company bought at a ridiculous price can still be a painful investment. For the average investor, Peter Lynch's practical lesson is empowering. You do not have to be a Wall Street insider to begin finding ideas. You can start with the world around you. What products are people using? What stores are expanding? What services are becoming part of daily life? What brands have loyal customers? What companies seem to be solving real problems? But then you must become a detective. Check the financials. Read the reports. Understand the business model. Look at debt. Look at profit margins. Look at competition. Look at growth potential. And ask whether the stock price makes sense. Lynch's approach rewards curiosity. It rewards common sense. It rewards patience. It rewards investors who can connect real-world observation with business analysis. This is why his style remains so popular. He made investing feel accessible without pretending it was easy. He showed that a normal person might notice a great company early, but he also showed that noticing is not enough. You still have to think like an owner. One of the most important questions Lynch encouraged investors to ask was, what is the story? Every stock has a story. A company is expanding. A company is recovering. A company is misunderstood. A company is entering a new market. A company is improving margins. A company is benefiting from a long-term trend. But the story must be clear. And over time, you must check whether the story is still true. If the company is supposed to be growing, is it still growing? If the company is supposed to be turning around, is it actually improving? If the company is supposed to have a strong brand, are customers still loyal? If the company is supposed to be cheap, why is it cheap? This habit can protect investors from blindly holding stocks they no longer understand. Peter Lynch's legacy is that he gave ordinary investors confidence, not false confidence, not reckless confidence, but the confidence to learn, to observe, to ask questions, to research, to think independently. He showed that investing does not have to be mysterious. A stock is not just a ticker symbol, it is a piece of a business. And if you can understand the business, understand the opportunity, understand the risks, and buy at a reasonable price, you have a chance to do well. His career also teaches another powerful lesson. Great investing ideas are not always hidden in complicated places. Sometimes they are in the mall, at the restaurant, in your home, on your phone, in the products people love, in the companies quietly becoming part of everyday life. But the opportunity belongs to the person who notices early, studies carefully, and has the patience to let the business grow. Peter Lynch became legendary because he connected Wall Street to Main Street. He proved that ordinary observation, combined with disciplined research, could lead to extraordinary results. And his greatest lesson may be this: do not invest in something just because everyone is talking about it. Invest in something because you understand it, you have researched it, the numbers make sense, and the story has room to grow. That is how Peter Lynch found great stocks. Not by chasing noise, but by paying attention to the real world before Wall Street caught up. 3. Benjamin Graham, the father of value investing. Benjamin Graham did not become one of the most important investors in history by chasing excitement. He did not search for the hottest stock. He did not try to predict the next trend. He did not believe investors should buy companies just because the story sounded inspiring. Benjamin Graham believed investing should be rational, disciplined, defensive, based on evidence, and most importantly, based on price. His central idea was simple but powerful. A stock is not just a symbol on a screen. A stock is a piece of a real business. And if you buy that business for less than it is truly worth, you create a margin of safety. That idea became the foundation of value investing, and it influenced generations of investors, including Warren Buffett. Benjamin Graham was born in London in 1894, and his family moved to New York when he was still a child. His early life was shaped by hardship. After his father died, his family struggled financially. This experience had a major effect on Graham. He understood what it meant to lose security. He understood that money could disappear. And later, as an investor, he became deeply focused on protection. Not just making money, avoiding permanent loss. That distinction is important. Many investors think first about how much they can make. Graham thought first about how much they could lose. He studied at Columbia University and later worked on Wall Street. But the event that shaped his philosophy most deeply was the stock market crash of 1929 and the Great Depression. During that period, investors saw fortunes vanish. Stocks that once seemed unstoppable collapsed. Optimism turned into panic. Confidence disappeared. And people who had bought based on excitement learned a brutal lesson. Price matters, debt matters, earnings matter, assets matter, risk matters. Graham survived that period, but it changed him. He became convinced that investors needed a system. Not emotions, not rumors, not speculation, a system. A way to estimate value, demand a discount, and protect themselves from being wrong. This became the heart of his philosophy. His most famous concept was the margin of safety. Imagine a company is worth $100 per share based on careful analysis. Graham did not want to pay $100. He wanted to pay much less. Maybe 70, maybe 60, maybe 50. Why? Because the future is uncertain. Your analysis may be wrong. The company may face unexpected problems. The economy may weaken. Management may disappoint. Markets may fall. A margin of safety gives you room for error. It protects you from overconfidence. It means you are not relying on everything going perfectly. This is one of Graham's greatest lessons. Good investing is not about pretending you can predict the future exactly. It is about building protection into your decisions because you know you cannot. Graham's style was very different from modern hype-driven investing. Today, many investors buy stocks because of a story: artificial intelligence, electric vehicles, crypto, a new app, a charismatic founder, a revolutionary product. Sometimes those stories are real, but Graham would ask a colder question: what is it worth? Not what could happen in the most optimistic scenario, not what people are excited about, not what the stock might do next week. What is the business worth today, based on assets, earnings, and conservative assumptions? And can I buy it for significantly less? That was Graham's discipline. He separated investment from speculation. To Graham, an investment operation was one based on thorough analysis, safety of principle, and an adequate return. Anything else was speculation. This does not mean speculation is always wrong, but Graham believed people should know the difference. If you buy because a price is rising, that is not the same as investing. If you buy because other people are excited, that is not the same as investing. If you buy without understanding the business, that is not investing. That is hoping. And hope is not a strategy. One of Graham's most famous teaching tools was Mr. Market. Mr. Market is an imaginary business partner. Every day, he offers to buy your share of a business or sell you his share. But Mr. Market is emotional. Some days, he is wildly optimistic and offers a very high price. Other days, he is depressed and offers a very low price. The key is that you do not have to obey him. You can ignore him. You can buy from him when he is pessimistic. You can sell to him when he is euphoric. But you should not let his mood control your own judgment. This metaphor is one of the most powerful ideas in investing. The market is there to serve you, not instruct you. Most people do the opposite. When the market rises, they feel confident. When the market falls, they feel afraid. They let prices tell them how to feel. Graham wanted investors to reverse that relationship. A falling price is not automatically bad. It may be an opportunity. A rising price is not automatically good. It may be a warning. The intelligent investor uses market volatility instead of being used by it. This is why Graham's approach required emotional discipline. Value investing often means buying what others dislike. It means owning stocks that may look boring, unpopular, or temporarily troubled. It means waiting, sometimes for months, sometimes for years, because a cheap stock does not become fairly valued just because you noticed it. The market may ignore it for a long time. This is one of the hardest parts of Graham's strategy. Being right is not enough. You also need patience. His big idea can be summarized like this: buy securities for less than their intrinsic value with a margin of safety, and let time correct the market's mistake. That sounds simple, but it is not easy. Because cheap stocks are often uncomfortable. They are cheap because people are worried. Maybe earnings are down. Maybe the industry is unpopular. Maybe headlines are negative. Maybe investors have lost interest. If everything looked perfect, the stock would not be cheap. Graham understood that discomfort is often part of the bargain, but he also knew that not every cheap stock is a good investment. This is the first major risk of his strategy. Some stocks are cheap because they deserve to be cheap. A company may have declining earnings, weak management, too much debt, a dying business model, poor competitive position, or assets that are worth less than they appear. This is called a value trap. A value trap looks cheap on paper, but the value keeps deteriorating. You think you are buying a bargain, but actually, you are buying a melting ice cube. Graham's answer was discipline. Use conservative assumptions. Look at the balance sheet. Study earnings history. Avoid excessive debt. Diversify. Demand a large margin of safety. Do not fall in love with the stock. The second risk is patience. A stock can remain undervalued for a very long time. The market does not have to agree with you quickly. You may buy something cheap and watch it stay cheap, or become even cheaper. This can test your confidence. Many investors give up before the value is recognized. They sell out of frustration, only to watch the stock recover later. Graham's approach required the ability to wait without constant validation. The third risk is that the world changes. A company that looked statistically cheap in the past may not be cheap if the future is permanently worse. For example, a business may appear undervalued based on old earnings. But if technology, competition, or consumer behavior has changed, those earnings may never return. This is why value investing cannot be only mechanical. Numbers matter, but judgment matters too. The fourth risk is missing great companies because they rarely look cheap. Graham often focused on bargains, but some of the best investments in history were high-quality businesses that did not look statistically cheap by traditional measures. This is where Warren Buffett later evolved. Buffett began with Graham's value discipline, but eventually combined it with lessons from Charlie Munger and Philip Fisher. Instead of buying fair businesses at wonderful prices, Buffett began looking for wonderful businesses at fair prices. Still, the foundation came from Graham. Do not overpay, demand value, protect against downside, think like an owner. For the average investor, Graham's practical lesson is extremely important. Before buying any stock, ask, what is this business worth? How do I know? What assumptions am I making? What could go wrong? Am I paying a price that gives me protection if I am wrong? Am I investing or am I speculating? Those questions can save people from many mistakes. They force discipline. They slow down impulsive decisions. They protect you from buying only because something is popular. Graham teaches that a good company is not automatically a good investment. Price matters. If you pay too much, even a good business can produce poor returns. And a disliked company can sometimes be a good investment if the price is low enough and the underlying value is real. This is one of the hardest ideas for beginners to understand. The quality of an investment depends not only on what you buy, but what you pay. Graham also teaches the importance of emotional independence. You cannot let the market's mood become your mood. If you need constant agreement from others, value investing will be difficult. The crowd will not applaud you when you buy unpopular stocks. The headlines will not comfort you. Prices may move against you. You need your own analysis, your own standards, your own discipline. That is what makes an intelligent investor, not someone who knows the future, but someone who behaves rationally under uncertainty. Graham's legacy is enormous because he gave investing a framework. Before him, much of the market was dominated by speculation, tips, rumors, and momentum. Graham brought structure. He showed that investors could analyze businesses, estimate value, demand safety, and make decisions based on reason instead of emotion. He taught that the market is not a casino if you refuse to behave like a gambler. And perhaps most importantly, he taught investors humility. The margin of safety exists because we are not perfect. We make mistakes. We misjudge businesses. We underestimate risk. We get surprised by the economy. We become emotional. A margin of safety is not just a mathematical concept. It is a confession of human limitation. It says, I might be wrong, so I will protect myself. That humility is one of the reasons Graham's ideas have lasted for decades. Benjamin Graham became known as the father of value investing because he changed the way people thought about stocks. He taught that a stock has value beyond its price, that market emotions create opportunity, that safety matters, that discipline beats excitement, and that the intelligent investor does not follow Mr. Market. He uses Mr. Market. His greatest lesson can be summarized in one sentence: buy with a margin of safety, think like an owner, and never confuse price with value. That principle influenced Warren Buffett, shaped modern investing, and remains one of the most important ideas in financial history. Because in the end, Benjamin Graham did not just teach people how to make money. He taught them how to protect themselves from the most dangerous force in investing, their own emotions. 2. Charlie Munger, the investor who became rich by avoiding stupidity. Charlie Munger did not become one of the greatest investors in history by trying to predict every market move. He did not chase the hottest stocks. He did not build his philosophy around complicated trading systems. And he did not believe investing success came from knowing thousands of tiny facts about the market. Munger believed something different. He believed the greatest advantage in investing was clear thinking, the ability to avoid obvious mistakes, the ability to stay rational when others became emotional, the ability to understand businesses deeply, and the ability to combine ideas from many disciplines into one powerful way of seeing the world. His philosophy can be summarized in one simple sentence: it is remarkable how much long-term advantage people can get by consistently not being stupid. That may sound funny, but for Charlie Munger, it was serious. Because most investors do not fail because the world is too complicated. They fail because they make avoidable mistakes. They chase hype, they overpay, they use too much debt, they follow the crowd, they panic during downturns, they buy businesses they do not understand. They confuse a good story with a good investment. Munger spent his life trying to avoid those traps. Charlie Munger was born in Omaha, Nebraska in 1924. The same city where Warren Buffett was born. But the two men did not become partners until much later. Before investing, Munger studied mathematics, served in the U.S. Army Air Corps during World War II, trained in meteorology, and later went to Harvard Law School without even having an undergraduate degree. He became a lawyer, then a real estate investor, then an investment manager, and eventually Warren Buffett's business partner at Berkshire Hathaway. That partnership became one of the most successful in business history. But Munger was not simply Buffett's assistant. He changed Buffett's investing philosophy. Before Munger, Buffett was heavily influenced by Benjamin Graham. Graham taught investors to buy cheap stocks, to look for bargains, to buy companies trading below their intrinsic value. That approach worked. But Munger pushed Buffett toward a better idea. Instead of buying fair businesses at wonderful prices, Munger encouraged him to buy wonderful businesses at fair prices. That shift changed everything. It helped Berkshire move beyond cheap, average companies and focus on exceptional businesses with durable competitive advantages. Companies that could compound value for decades. Businesses with strong brands, high returns on capital, honest and capable management, pricing power, loyal customers, and economic moats that competitors could not easily destroy. This was one of Munger's biggest contributions to investing. He understood that quality matters. A cheap stock can be a trap if the business is mediocre. A wonderful business can create enormous wealth if bought at a reasonable price and held for a long time. Munger did not want to constantly buy and sell. He wanted to find rare, excellent opportunities and then sit still. That sounds easy, but it is incredibly hard. Most investors feel pressure to act. They want new ideas, new trades, new predictions, new excitement. Munger believed that great investing often requires the opposite: patience, discipline, waiting, doing nothing until the right opportunity appears, then acting decisively. This is why he often talked about having a small number of truly great ideas. You do not need hundreds of investments to do well. You need a few outstanding decisions protected from major mistakes. Munger's big idea was not just value investing. It was worldly wisdom. He believed investors should build a latticework of mental models. That means learning the big ideas from many fields: economics, psychology, mathematics, physics, biology, history, engineering, accounting, business, human behavior. Why? Because the world does not organize itself into neat academic categories. A business problem may involve psychology. An investment decision may involve incentives. A market bubble may involve social proof, greed, and bad accounting. A management mistake may involve ego, denial, and poor feedback systems. If you only understand finance, you may miss the real cause of what is happening. Munger wanted to think broadly. He believed that the best investors were not narrow specialists. They were multidisciplinary thinkers. They could see patterns others missed because they had more tools in their mind. One of his favorite ideas was incentives. He believed incentives are one of the most powerful forces in human behavior. If you want to understand why people act a certain way, look at what they are rewarded for. A CEO paid for short-term earnings may sacrifice long-term strength. A salesperson paid by commission may push products customers do not need. A fund manager judged every quarter may avoid unpopular long-term opportunities. A company with the wrong incentives can make bad decisions even if the people inside are smart. Munger understood that incentives often explain behavior better than words. This is a powerful lesson for investors. Do not just listen to what management says. Ask how they are rewarded. Do they own stock? Do they think like owners? Are they paid for long-term value creation? Or are they paid for short-term appearances? Another mental model Munger emphasized was inversion. Instead of only asking, "How do I succeed?" ask, "How do I fail?" Then avoid those things. This sounds simple, but it is extremely powerful. If you want to build wealth, ask, "How do people destroy wealth?" They use too much leverage. They buy things they do not understand. They panic sell. They follow crowds. They ignore valuation. They trust dishonest people. They concentrate everything in one fragile bet. They let ego control decisions. Avoid those mistakes, and your odds improve dramatically. Munger often believed that avoiding stupidity was more reliable than trying to be brilliant. This is especially true in investing. You do not have to make perfect decisions every day, but you must avoid decisions that can permanently damage you. One catastrophic mistake can erase years of progress. That is why Munger cared so much about risk. Not volatility, not temporary price movement, but real risk. The risk of permanent capital loss, the risk of owning a bad business, the risk of trusting bad management, the risk of leverage, the risk of not understanding what you own. Munger's strategy also required patience with concentration. He believed that when a truly great opportunity appears, it can make sense to bet meaningfully, but only if you understand it deeply. This is different from reckless concentration. Munger was not saying, put everything into one exciting stock. He was saying that truly great opportunities are rare, and when you find one inside your circle of competence, at the right price, with a strong business behind it, you should not treat it like just another tiny position. But that idea comes with serious risks. The first risk is overconfidence. Many investors think they understand a business better than they actually do. They hear Munger talk about concentration and use it as an excuse to take huge risks. But Munger's concentration came from deep knowledge, discipline, and patience, not from excitement. If you concentrate in something you barely understand, you are not following Munger. You are gambling. The second risk is waiting too long. Munger's philosophy values patience, but patience can become passivity. Some investors wait forever for the perfect opportunity and never act. Others reject good opportunities because they are searching for flawless ones. But no investment is perfect. Even great companies have risks. Even good prices can fall lower. The challenge is knowing the difference between discipline and fear. The third risk is overpaying for quality. Munger loved wonderful businesses, but wonderful businesses are not worth infinite prices. If everyone recognizes that a company is excellent, the stock may become too expensive. A great business bought at a terrible valuation can still produce poor returns. Quality matters, but price still matters. The fourth risk is intellectual arrogance. Munger was famous for mental models, but mental models can be misused. Some people learn a few concepts and start sounding smarter without actually making better decisions. The point is not to collect clever phrases. The point is to improve judgment. A mental model is useful only if it helps you see reality more clearly. For the average investor, Charlie Munger's practical lesson is incredibly valuable. You do not need to be a genius. You do not need to predict the economy. You do not need to trade every day. You do not need to own hundreds of stocks, but you do need to think clearly. Before buying a company, ask, do I understand this business? Does it have a durable advantage? Is management honest and capable? Are incentives aligned with shareholders? Can the company survive difficult times? Am I buying at a reasonable price? What could go wrong? And most importantly, am I fooling myself? That last question may be the most important. Munger understood that human beings are very good at self-deception. We believe what we want to believe. We defend our mistakes. We search for information that confirms our opinion. We follow the crowd because it feels safe. We become greedy when prices rise. We become fearful when prices fall. The investor's greatest enemy is often not the market. It is the mind. This is why Munger studied psychology. He wanted to understand cognitive biases, why people make irrational decisions, why smart people do foolish things, why crowds go insane, why incentives distort judgment, why denial is so dangerous. He believed that understanding human misjudgment could help investors avoid disastrous errors. That may be his greatest legacy. Not one stock, not one trade, not one formula, but a way of thinking, a way of becoming less foolish over time. Charlie Munger taught that investing is not just about money. It is about judgment, character, patience, rationality, learning, humility, and the discipline to avoid obvious mistakes. His partnership with Warren Buffett showed the power of combining value, quality, patience, and clear thinking. Together, They built Berkshire Hathaway into one of the most admired companies in the world. But Munger's lessons go far beyond Berkshire. He taught investors to think like owners, to study businesses deeply, to respect incentives, to use mental models, to avoid leverage, to stay inside their circle of competence, to wait for great opportunities, and to never underestimate the power of stupidity. His greatest lesson may be this: you do not have to be brilliant if you can consistently avoid being foolish. That idea is simple, almost too simple, but it is one of the hardest things to practice, because the world constantly tempts investors into foolishness. There is always a hot trend, a popular stock, a confident expert, a new prediction, a shortcut, a chance to get rich quickly. Munger's advice cuts through all of it. Think clearly, avoid stupidity, buy wonderful businesses when the price makes sense, hold patiently, keep learning, and protect yourself from your own worst instincts. Charlie Munger became one of the greatest investors in history, not because he knew everything, but because he spent his life trying to remove ignorance, bad judgment, and unnecessary mistakes. And in investing, that may be one of the greatest advantages of all. 1. Warren Buffett, the investor who got rich by thinking. Long term, Warren Buffett did not become one of the richest investors in history by chasing trends. He did not build his fortune by jumping from one hot stock to another. He did not try to predict every recession, every interest rate decision, or every market crash. Buffett became legendary by doing something that sounds simple, but is extremely rare. He bought great businesses, he bought them at sensible prices, and then he gave time the chance to do its work. That is the foundation of Warren Buffett's entire investing philosophy: patience, discipline, business quality, emotional control, and the power of compounding over decades. Most people want to get rich quickly. Buffett showed the world what happens when someone is willing to get rich slowly. Warren Buffett was born in Omaha, Nebraska in 1930. From a young age, he was fascinated by business and money. He delivered newspapers. He sold chewing gum. He sold Coca-Cola bottles. He looked for small ways to make money before most kids were even thinking about business. But Buffett was not just interested in earning. He was interested in understanding. Why did some businesses make more money than others? Why did some companies survive for decades? Why did some investments grow while others disappeared? That curiosity became the engine of his career. Buffett later studied under Benjamin Graham, the father of value investing. Graham taught him that a stock is not just a price moving on a screen. A stock is a piece of a business. And the intelligent investor should buy that business only when the price is below its true value. This lesson shaped Buffett deeply. Early in his career, he looked for what Graham called cigar butt investments. These were cheap, often mediocre companies that still had one last puff of value left. They were not beautiful businesses. They were bargains. Buffett could buy them for less than they were worth, wait for the market to recognize the value, and make a profit. That strategy worked, but over time, Buffett evolved. And one of the people who pushed him to evolve was Charlie Munger. Munger helped Buffett understand that it was often better to buy a wonderful business at a fair price than a fair business at a wonderful price. That idea changed everything. Buffett began focusing more on business quality. He wanted companies with durable competitive advantages. Companies that could earn strong profits for many years. Companies with trusted brands. Companies with pricing power. Companies with honest and capable management. Companies that did not need constant reinvention just to survive. Companies that could compound value quietly over time. This became the Warren Buffett style most people know today. He was not just buying stocks, he was buying ownership in businesses. And that difference matters. Most investors think like traders. They ask, will this stock go up next week? Will earnings beat expectations? What will the market do tomorrow? Buffett asks different questions. Would I want to own this entire business? Will it still be strong 10 or 20 years from now? Does it have a moat? Can competitors easily attack it? Does management allocate capital wisely? Is the price reasonable compared to the cash the business can produce over time? That is a completely different mindset. Buffett does not see stocks as lottery tickets. He sees them as ownership claims on productive assets. His big idea is that wealth is built by owning exceptional businesses for long periods of time. And the longer you hold a great business, the more powerful compounding can become. Compounding is one of the most important forces in Buffett's life. When money earns a return, and then that return earns its own return, wealth can grow exponentially. But compounding needs time. It does not reveal its full power in 1 year, or 3 years, or sometimes even 10 years. It becomes extraordinary over decades. This is why Buffett's patience is so important. Many people know about compounding. Few people have the temperament to let it work. They interrupt it. They sell too soon. They panic during downturns. They chase something more exciting. They get bored. They want faster results. Buffett's genius is not only that he understands compounding, it is that he has built his life around not interrupting it. One of Buffett's greatest advantages has always been emotional discipline. Markets are emotional. People become greedy when prices rise. They become fearful when prices fall. They overreact to headlines. They confuse short-term price movement with long-term value. Buffett learned to use this behavior instead of being controlled by it. When markets panic, he does not automatically panic. When investors become euphoric, he does not automatically join them. He understands that the market is there to offer prices, not wisdom. Sometimes the market offers a wonderful business at a ridiculous price. Sometimes it offers an average business at an absurd price. The investor's job is to know the difference. This is why Buffett often talks about temperament. You do not need an extremely high IQ to be a successful investor. You need the right behavior. You need patience. You need discipline. You need the ability to ignore the crowd. You need the ability to stay calm when other people are emotional. This may sound easy, but it is not. Imagine owning stocks during a crash. Your portfolio is falling. The news is terrifying. Experts are warning about disaster. People around you are selling. Your instincts tell you to do something. Buffett's approach tells you to think. What is the business worth? Has the long-term value changed? Or is the market simply afraid? That ability to separate price from value is one of Buffett's core strengths. Price is what you pay. Value is what you get. The two are not always the same. A stock price can fall even if the business is still strong. A stock price can rise even if the business is weakening. The market can be wrong in both directions. Buffett tries to take advantage of that gap, but he does not buy everything that falls. This is important. Buffett is patient and selective. He often says that investing is like baseball, except there are no called strikes. You do not have to swing at every pitch. You can wait. You can ignore thousands of opportunities. You can do nothing for long periods. And when the right opportunity comes, you can swing hard. This is one of the hardest lessons for investors to accept. Doing nothing can be an intelligent decision. In a world obsessed with activity, Buffett's patience looks strange. Financial media wants action. Trading apps encourage movement. Social media rewards bold predictions. But Buffett understands that activity and progress are not the same thing. You can trade constantly and get nowhere. You can make fewer decisions and build enormous wealth. The quality of decisions matters more than the quantity. Buffett's big idea can be summarized like this: buy wonderful businesses at sensible prices, hold them for a long time, and let compounding do the heavy lifting. That sounds simple, but simple does not mean easy. There are serious risks in Buffett's approach. The first risk is overpaying for quality. A great business is not automatically a great investment at any price. If you pay too much, future returns can be disappointing. Even an excellent company can become a poor investment if the stock price already assumes perfection. Buffett is famous for loving great businesses, but he is also disciplined about price. He wants value, not just quality. The second risk is misjudging the moat. A moat is a company's durable, competitive advantage. It protects profits from competitors. But moats can shrink. Technology can change. Consumer behavior can shift. Brands can weaken. Management can make mistakes. A business that once looked untouchable can become vulnerable. This is why investors must keep thinking. Long-term investing does not mean blind loyalty. It means holding as long as the business remains strong and the investment thesis remains valid. The third risk is patience turning into stubbornness. Buffett is patient, but patience is not the same as denial. If the facts change, a good investor must be willing to update their view. Some investors misunderstand Buffett and think they should never sell anything. That is not the lesson. The lesson is not to sell because of noise. But if the business deteriorates, if the moat disappears, or if management destroys value, the original reason for owning may no longer exist. The fourth risk is that most people cannot emotionally handle long-term investing. They say they are long-term investors until the market falls. They say they love bargains until their own stocks are down. They say they believe in compounding until another investment rises faster. Buffett's strategy requires emotional strength, not just intellectual agreement. For the average investor, the practical lesson from Warren Buffett is extremely powerful. You do not need to predict every market move. You do not need to trade every day. You do not need to understand every industry. You do not need to own hundreds of stocks. But you do need to think like an owner. Before buying a stock, ask, do I understand this business? Does it have a durable advantage? Can it earn money for many years? Is management honest and capable? Does the company use capital wisely? Would I be comfortable owning it if the stock market closed for 5 years? And am I paying a reasonable price? That final question matters. Buffett combines quality with value. He does not just want cheap companies. And he does not just want great companies. He wants great companies at prices that make sense. Another practical lesson is to stay inside your circle of competence. Buffett does not invest in everything. He does not pretend to understand every technology, every trend, or every business model. He focuses on what he can understand. This is a major advantage. Many investors lose money because they feel pressure to have an opinion on everything. Buffett shows that you can ignore most things. You only need a few good opportunities in areas you truly understand. Your circle of competence does not need to be huge, but you must know where its boundaries are. That is where humility comes in. Buffett is confident, but he is also careful. He understands that not knowing something is not a weakness. Pretending to know is the danger. This is why he avoids many investments that others find exciting. If he cannot understand the business, he passes, no matter how popular it is, no matter how much money others are making, no matter how strong the hype becomes. That discipline protects him. Buffett also teaches the importance of reputation and trust. He has often said that it takes years to build a reputation and only minutes to destroy it. This applies to business. It applies to management, and it applies to personal finance. Trust is an asset. Good management matters because shareholders are trusting other people to allocate capital. If managers are dishonest, reckless, or self-interested, even a good business can become a bad investment. Buffett wants managers who think like owners, people who care about long-term value, not just short-term appearances. This is one reason Berkshire Hathaway became so unusual. Buffett built a company designed for long-term thinking. Not quarterly drama, not constant trading, not financial engineering for headlines. but patient ownership of businesses and investments. Berkshire became a compounding machine because Buffett structured it around principles that matched his philosophy: capital allocation, decentralized management, long-term ownership, trust, discipline, and rationality. But perhaps the most important lesson from Warren Buffett is that wealth does not have to be complicated. Many people assume that investing must be complex because finance looks complex. There are charts, formulas, forecasts, and endless opinions. Buffett cuts through that complexity. Buy productive assets, avoid unnecessary debt. Think long-term. Do not overpay. Stay rational. Let time work. Those principles are simple, but following them for decades is rare. That is why Buffett's story is so powerful. His strategy is not built on secrets, it is built on behavior. Everyone knows patience is good. Few people are patient. Everyone knows buying low and selling high makes sense. Few people can buy when fear is everywhere. Everyone knows compounding is powerful. Few people leave it alone long enough. Buffett's edge is not that he discovered a hidden formula no one else can understand. His edge is that he consistently practiced principles most people abandon. That is what makes him extraordinary. He turned common sense into uncommon results. For the average person, Buffett's life offers one clear message. You do not need to be a genius to build wealth, but you do need discipline. You need to spend less than you earn. Invest in things you understand. Avoid emotional decisions. Be patient. Keep learning. Protect your reputation. And let good decisions compound over time. Warren Buffett became one of the greatest investors in history because he understood that time is the friend of a wonderful business and the enemy of a mediocre one. He understood that the stock market is emotional, but the investor does not have to be. He understood that owning great businesses can be far more powerful than constantly trading average ones. And he understood that the biggest money is often made not by doing more, but by holding on. His greatest lesson may be this: successful investing is not about being right every day. It is about making a few excellent decisions, avoiding major mistakes, and giving those decisions enough time to matter. That is Warren Buffett's genius. Not speed, not hype, not prediction, patience, discipline, quality, value, and the quiet power of compounding. When you look at these 10 investors together, one thing becomes clear. There is no single way to become wealthy. Benjamin Graham built his philosophy around buying assets for less than they were worth. Philip Fisher focused on finding exceptional companies with long growth potential. John Templeton made his fortune by buying when fear was everywhere. Peter Lynch believed ordinary people could find great ideas in the real world before Wall Street noticed. John Bogle simplified everything and showed that low-cost index investing could be one of the most powerful strategies for regular investors. Ray Dalio studied history, debt cycles, inflation, interest rates, and the economic machine. George Soros searched for moments when market beliefs became unstable and reality was about to break through. Jim Simons used mathematics, data, and technology to discover patterns hidden inside market noise. Charlie Munger focused on mental models, rationality, and avoiding obvious stupidity. And Warren Buffett built wealth by owning great businesses for very long periods of time. Different methods, different personalities, different levels of complexity, different types of risk, but underneath all of them, the same principles appear again and again. The first principle is patience. Almost none of these investors became successful overnight. Buffett needed decades for compounding to become extraordinary. Bogle's index strategy required investors to stay the course for the long term. Fisher's growth companies needed time to expand. Templeton often had to wait for hated markets to recover. The world loves quick money, but the greatest investors understand that time is one of the most powerful forces in finance. The second principle is discipline. Each investor had a process. Graham demanded a margin of safety. Lynch wanted investors to understand the story and the numbers. Dalio built systems to prepare for different environments. Simons tested ideas with data instead of trusting opinions. Great investors do not just wake up and guess. They follow rules. They have standards. They know what they're looking for. And just as importantly, they know what they will avoid. The third principle is emotional control. Markets are emotional machines. They create greed when prices rise and fear when prices fall. Most people are pulled in both directions. They buy when they feel safe. They sell when they feel scared. But the great investors learn to separate emotion from decision-making. Templeton bought during maximum pessimism. Graham used Mr. Market instead of being controlled by him. Buffett stayed calm while others panicked. Munger studied human misjudgment because he knew that the mind can be an investor's greatest enemy. The fourth principle is informational advantage. Each of these investors had some form of edge. Fisher talked to customers, suppliers, competitors, and industry insiders. Lynch observed real-world businesses before they became obvious. Soros understood macroeconomic pressure points. Dalio studied cycles across history. Simons built a machine that could process data at a level no ordinary investor could match. An edge does not always mean secret information. Sometimes it means better research. Sometimes it means better behavior. Sometimes it means a longer time horizon. Sometimes it means lower costs. Sometimes it means understanding one area deeply while others are distracted. The fifth principle is consistency. A good strategy only works if you can keep following it. Index investing fails if you abandon it during a crash. Value investing fails if you cannot wait. Growth investing fails if you sell every winner too early. Macro investing fails if you cannot manage risk. Quant investing fails if you stop improving the system. The great investors were not great because they were right every day. They were great because they kept applying their philosophy through changing markets, criticism, uncertainty, and pressure. And that may be the most important lesson of all. You do not need to copy any one of these investors perfectly. Most people should not try to trade like George Soros. Most people cannot build a firm like Jim Simons. Most people will never analyze businesses exactly like Warren Buffett or Charlie Munger. But you can learn from their principles. You can demand a margin of safety. You can think like an owner. You can keep costs low. You can avoid emotional decisions. You can study what you understand. You can be patient when others are impatient. You can avoid obvious mistakes. You can build a process and follow it. Because wealth is not only about finding the perfect investment. It is about becoming the kind of person who can make good decisions consistently. That is what these 10 investors teach us. There are many paths to wealth. But every serious path requires discipline. Every serious path requires patience. Every serious path requires emotional control. And every serious path requires the ability to keep going when the crowd is distracted, afraid, or chasing something new. The strategies may be different, but the foundation is the same. Think clearly. Control your emotions, find your edge, stay consistent, and give time the chance to work. That is how great investors build wealth, and it is also how ordinary people can begin to build it too. Follow Short Rich to continue learning valuable lessons from great investors and gain more wisdom when managing your finances.